This is Horizon's Middle East and Africa, our top stories this morning. The Kiwi jumps with government bond yields as the RBNZ signals rate cuts may be delayed to later in 2025. Asia struggles to keep the rally going. The S&P 500, though, notching a fresh record as we await results from Nvidia. Plus, our coverage in the lead-up to South Africa's election continues with Annabel Bishop, Chief Economist at Invectec. Oh, good morning, everybody. It's just gone 8 a.m. across the Emirates. I'm Jemana Bersetchi in Dubai. As ever, let's get you caught up on some of these market moves. The big mover yesterday was the S&P. We saw a record close for the S&P 500. 5,321 to be precise, up 0.25%. So not a major move in terms of intraday volatility, but still inching higher as, of course, the market turns to the big event today, and that is, of course, Nvidia earnings. You can see the MSCI Asia Pacific Index trading a bit sideways today. Not a lot of action to the upside, again, as some of the news from the region starts to get priced in, namely that RBNZ decision. You can see there, Aussie Kiwi, one of the big movers overnight as well, and you can see that we saw an upward move of about 0.5%. This as the RBNZ surprised by being a lot more hawkish than what the market had been anticipating. We'll talk more about that shortly with Israel. And then Brent also on our radar, slipping today down 0.7% below that $83 handle. Some real questions about supply, but also the weakish demand outlook. We spoke about Nvidia. This is our top chart that we're going to be looking at today, and how much the market is pricing in for Nvidia to move. So options markets are implying an 8% move either way. And if that does happen to the downside, it could wipe out about $188 billion in market cap. I would just remind viewers that if you rewind back to 3 months, Nvidia actually surprised to the upside on their earnings. They came about 12% higher than what the market was anticipating. And on the back of that, we saw a 16% move higher in the stock price. So there is a lot of volatility priced in. And yet, if they do surprise to the upside, we could see quite a significant move also once again, similar to what happened last quarter. All right, let's check in on how markets in Asia are faring. Avril Hong is in our Singapore studio, and some reaction coming through to that more hawkish RBNZ.
Yeah, certainly we're seeing that reaction already in Kiwi bonds and the currency. But let's also talk about what we're seeing in the Asia Pacific, because it is a lack of direction ahead of those Nvidia earnings. And it's not just that we're watching in the Asia Pacific, it's also among the Chinese tech aids. We're going to get Pinduoduo later today, and then NetEase as well, Xiaomi tomorrow, and that perhaps could give a further boost to Chinese tech stocks that have been moving sideways for this week. Now, we're seeing the Nikkei, quite clear direction coming through here in negative territory, and this is after Japan's trade deficit came in deeper than expected, showing how the weak yen is playing out in the value of imports, perhaps complicating things further for the Bank of Japan. Flip the board, let's take a look at what we're seeing cross assets in New Zealand, because as you say, it was more hawkish than markets anticipated. There was some that actually thought we could see dovish signaling from the RBNZ. That's clearly not what we got. It said from its forecast that it sees cuts in the third quarter of next year, not the second quarter. And it also talked about rate hikes at its latest meeting. So we're seeing the bonds really coming under pressure in New Zealand, and the Kiwi dollar is gaining ground against the greenback and also the Aussie dollar, Jumana.
Yeah, the fact that not only are they pushing back on the idea of rate cuts, but they actually talked about rate hikes, I think is quite significant. Avril, thank you for the overview. Now, turning to our top Middle East story today, Bloomberg has learned that the U.S. has softened its earlier resistance to a broader military operation by Israel in Rafah. A U.S. official told us that Israel has updated its plan over Washington's humanitarian concerns about a full-scale offensive. Paul Wallace, our Middle East economy and government editor, joins us for the latest. Well, this is quite an important story. I know that it is from our own sourcing. We at Bloomberg have spoken to a U.S. official. But what do we know about the U.S. easing or reducing some of their hesitation about Israel's potential offensive, full ground offensive into Rafah?
Jemana, exactly. It is pretty important. And I think what it shows is that the U.S. has less concern right now about what Israel and the IDF are doing in Rafah. And they haven't gone into the center of the city yet. The forces are still operating on the outskirts. They've taken over the Rafah border crossing between Egypt and Gaza. But the Americans seem to be signaling that they're happier now than they were about a week ago or a few weeks ago about what Israel is doing with regards to the humanitarian situation.
Why? That's exactly my question. Why are they less concerned now?
It's not entirely clear, but I think that what the U.S. has seen so far with the operations in Rafah are not the high casualties among civilians that they feared. Yes, there have been casualties for sure and fatalities among civilians in Rafah, but not the huge numbers that they were presuming would happen only a few weeks ago. In fact, almost 1 million civilians in Rafah have moved out of the city, effectively being forced north by the IDF.
So essentially, because in their view, because so many people have left or moved out of Rafah, there's less of a concern about some of these civilian casualties that could occur, and yet still there are hundreds of thousands still people living in Rafah. And I thought another story that was really important overnight is that there were scenes of desperate Palestinians storming U.S. aid trucks to get access to this humanitarian aid, to get access to food. I mean, what does that tell us about the situation on the ground?
I think it shows just how chaotic things are across Gaza. As you mentioned, the aid that has been coming in via this U.S.-built pier on the shore of Gaza so far is proving very, very difficult to distribute. The UN essentially saying that whatever it's sending to that pier and which it's trying to send to warehouses to get processed and distributed properly isn't getting there because Gazan civilians who are desperate for food and aid are blocking these trucks and things when they come off the pier and just taking the food for themselves, which is pretty much as you'd expect given the situation there. It speaks of a power vacuum because what the IDF is doing, it's been clearing areas of Hamas fighters, but it hasn't been holding them. It's been moving out very quickly. So there are actually few parts of Gaza where there are IDF troops. What that means is that there's no governing authority in most of the Gaza Strip. And the US and others have said that means you're seeing either, gangs taking hold of areas or Hamas is regrouping.
So I read a report from the UN overnight also that suggests that up to 1 million Palestinians living in Gaza are at risk of famine or very close to famine situations. And you've got to take that in juxtaposition with that ICC judgment yesterday with the chief prosecutor looking to get an arrest warrant for the Israeli prime minister because one of the crimes that he's been accused of is using starvation as a means of a war crime, essentially. The use of starvation as a tool in times of war is perceived to be a war crime in the ICC's eyes. There's been a lot of fallout from the international community, but how would we marry the situation overnight, the fact that Palestinians are storming these U.S. aid trucks, with the ICC judgment yesterday?
So the ICC's chief prosecutor has essentially pointed to that situation, the parts of Gaza, large parts being on the brink of famine, according to the UN, and saying that is evidence that Benjamin Netanyahu, Israel's defense minister, and Israel's defense minister Yoav Gallant have used starvation as a weapon of war. That's a charge that they have denied strenuously. The Israelis keep insisting that they are flooding or trying to flood Gaza with aid. They say the situation is not getting aid into Gaza. It's what happens after that. The IDF doesn't control the distribution, and that's part of the problem, this chaos that I was talking about, because there's no governing authority pretty much everywhere in the Strip. But you're right, this is what the ICC chief prosecutor has pointed to. There's been a very strong backlash from the US officials, including Joe Biden, have said that the ICC is, or the chief prosecutor is very wrong to pursue this. There's even talk of potential US sanctions on the ICC or some of its judges because of this. However, in other parts of the world, in some parts of Western Europe, we have seen leaders say that this is an important step by the ICC to, or the chief prosecutor, to look at arrest warrants not only for Israeli leaders but for Hamas leaders too, and that they
welcome the decision.
These,
some parts of Europe, European voices. I saw that yesterday.
They should answer these allegations.
Yeah, Paul. Thank you for the overview this morning. That was Paul Wallace, our Middle East economy and government editor. Well, on to the top market story today. Nvidia will be delivering its much-anticipated results later, giving investors a fresh read on the staying power of the AI boom. Analysts see revenue soaring 243% in the first quarter. And the company has seen its sales jump in the past year, boosted by explosive growth in its data center division. Nvidia's H100 chip, a so-called AI accelerator, has become the hottest commodity in Silicon Valley. It also recently announced a new platform called Blackwell. The primary concern for investors will be whether it can get enough supply from Taiwan's TSMC to meet some of the loftier projections for its growth. And of course, we will be watching out for that later today when the results come out. And there you have a picture of just how much those data centers for Nvidia have grown in the last year, 390%. That's a picture of the stock. Well, Nvidia shares dipped in early U.S. trade yesterday after reports that Amazon Web Services has stopped orders of its Grace Hopper chips to wait for those new Blackwell processors. The Financial Times reports AWS made the move due to small time frame between the release of Hopper and announcement of Blackwell at just 7 months. And still ahead, we'll get the market outlook with Julius Baer as traders await Nvidia's earnings while digesting a flurry of Fed speak. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jemana Bersetchi in Dubai. One of Wall Street's most prominent bears is turning positive. Morgan Stanley's chief U.S. equity strategist, Michael Wilson, now sees the S&P 500 touching a record high by next June, an about turn from his earlier view that the benchmark would slip by December.
I wouldn't be surprised if we hit both sides. I mean, like, that's kind of the world we're in, which is, think about this year, and we talked about this at the beginning of the year, which is we had three sort of equally similar sort of outcomes. One was a soft landing, just a Goldilocks, which is kind of consensus now, and that's our house view. Then you have the no landing, which is kind of a reacceleration, the stickier inflation, even maybe a stagflationary outcome, which is what the market was thinking about in April. And now you're back to a soft landing, but you still can't rule out a recession either, right? So, like, all of these are very possible, and they could all happen with a higher than normal degree of certainty. So that's really the headline that should have been out, is that, look, nobody knows anything, right? I mean, and particularly at a point in time, and I think maybe our mistake is just admitting that we don't know as much as maybe everybody else claims to. That's called humility, something that we've learned the hard way over life. But anyways, the point here is that the meat of our report this year, or this update, was really more about how do you make money in an environment where you have basically 0% upside and the base case, and you could have 20% upside or 20% downside. And that's what clients pay us for, right? It's the process. It's understanding, okay, what kind of environment and how are we going to navigate that and manage that? So we spent a large part of the report yesterday talking about trade ideas, specific sector ideas. That's not the headline that people want to write about. That's fine. That's your prerogative. But that's what we want to talk about.
That was never going to fit in the headline. No. We will talk about some of that stuff in just a moment. Let's talk about the headline just briefly.
Sure.
Are you de-emphasizing the 5,400? Are you saying as a price target it's not actually that important to you and the firm? What is that?
Well, it's not important to most clients. Institutional clients don't care about the target on the S&P 500. Let's be honest. They're trying to pick stocks. And look, one of the most important things we talked about in the report is alpha generation this year has been spectacular. The way we measure it with our client base, which is significant, is this is the best alpha generation, alpha capture we've seen since we've started recording it since 2010. So that's what people care about. We're trying to help them in that their process of, okay, what kinds of stocks work in this environment? Oh, by the way, when we skew from these different outcomes, you need to be ready to pivot towards different types of securities. Right now, like, our house call is it's a soft landing Goldilocks outcome. We're not that confident that we want to make that bet fully. Like, we think it's still late cycle, which means quality. Okay, large caps over small caps still. We like staples over discretionary. We have two defensive sectors overweight, utilities and staples, because that kind of protects against slowing growth risk. So there's a bunch of different things, but the main factor that's been working is quality. Quality's been the most consistent factor, and we don't see that changing.
Are there specific sectors that win regardless of the overall index? Do you see certain areas that are kind of independent of this overall shift of whether there is this momentum in international money that pours in and keeps valuations high and sets them higher?
It's large cap quality. I mean that is what continues. And by the way, it's not just high growth; it's also cyclicals can work in that, but it's still up the quality curve. And we show it in the note very clearly. I mean, it's been the best carry factor for the last year and a half, which is a classic late cycle winner, which is where we are.
Well, that was Morgan Stanley Chief U.S. Equity Strategist Mike Wilson. I also spoke to him a couple of weeks ago here in Dubai, talking about their revised target for S&P 500, throwing in the towel on the bearish outlook, sounding slightly more bullish on that topside forecast. Well, also coming up on our show, oil in focus as more bearish signs emerge in the market ahead of the OPEC Plus meeting early next month. This is Bloomberg.
This economy has been incredibly resilient, stronger than I expected, and I've been really pleased by how fast inflation has come down in spite of that.
But I think it's a little too soon to determine where inflation necessarily is going. Base case, I do think we're going to have inflation come down, but I think it's going to take longer.
I think this is a moment when, or a period when patience really matters. It's going to take longer for us to see the extent of progress that I think is going to be necessary to change our policy stance.
Frankly, we're not taking a big risk by doing that because so far the labor market remains very healthy.
Well, that was some of the latest commentary from Fed officials, signaling that rates will stay higher for longer. And over in Asia, the Reserve Bank of New Zealand has doubled down on its hawkish tone after holding its key rate today. The central bank also signaling rates will need to stay tight for longer than previously expected. Let's bring in Mark Matthews, Head of Asia Research at Julius Baer. Good morning to you. Just wrapping all of that commentary together, a lot of the Fed officials sounding quite hawkish still concerned about the trajectory of inflation. Obviously, RBNZ overnight, a bit of a hawkish surprise to the market as well, suggesting that not only are rate cuts forthcoming, but actually rate hikes were discussed at this meeting. What does that tell you about the wedge between what markets want to see versus how central bankers are viewing the inflation climate today?
There is a wedge, and I think the Fed Fund futures are pricing in about 4.8% by next January, which implies 3 rate cuts. And if the economy is so strong, we don't need that many, which it is. And Raphael Bostic just said it, but you can look at global trade volumes, you can look at global purchasing managers indices, and then some leading indicators like Japan machine tool orders, Taiwan new export orders. They're all actually pointing to a global economy that's accelerating, not decelerating.
Yeah.
So, yeah, you don't need so many cuts.
Well, that's the thing, right? Because the market would like to see cuts, obviously, but to your point, the global growth engine is still powering on. And I just wonder if the world today actually doesn't need low interest rates, that we are back to those, the interest rate environment that we saw in the 90s and not the interest rate environment that we had over the last decade post-GFC.
I agree wholeheartedly. And we woke up every day and the world turned back in the 90s when we had a 10-year Treasury yield at about 5% throughout that decade. And so we didn't really get into these very low interest rates till after the global financial crisis. And so our forecast for the 10-year Treasury yield is for 4.6 12 months from now, which is actually a little higher than where it is now. And I think the markets will be fine with that as long as we have earnings growth, which we certainly do. Earnings growth will be double-digit this year and probably next year, too.
Let me just get your take on what has been happening in China. Several measures announced recently, property measures, the authorities clearly trying to do something to stimulate the property sector. Are they going to be successful?
I think they will. 300 billion renminbi is, I think, the number that they're talking about, that they're going to get state-owned banks to lend out to municipal governments, which in turn will buy up this stock. And the most optimistic numbers would imply that's about a third of the total empty residential housing inventory, which means there's still 2/3 left. But I think it's a very good first move, and it does show an important policy change, because this had been proposed to the central government by economists back in January, and it said no. So the fact that it's saying yes now, in my opinion, implies a major shift in thinking. And if I add it to what I see as most data still being very weak, but the gradient is starting to turn positive in almost every Chinese data.
Is that what is driving Chinese stocks higher the last couple of months? What has caused this turnaround?
Oh, well, what caused it was a meeting way back on the 22nd of January of the State Council, where the Prime Minister, Li Qiang, said they would stabilize capital markets. And that was the bottom of the market. And in the beginning, nobody believed in this rally, because Chinese stocks went down in 2020 and 2021 and 2022 and 2023. And they were down in January, so people had, basically said there's no light at the end of the tunnel. They didn't believe in this rally in the beginning, and then it started going up very fast just a few weeks ago. I guess on the idea that they would be announcing a major policy shift in property, which they have, obviously. I put it together. I added with the fact that it's still an incredibly cheap market, and I think it will go higher.
Before I let you go, do you have a target?
I would say 30% over the next 12 months for the Hang Seng Index is perfectly achievable.
All right. Well, we got the target then. Mark, thank you so much for joining me today on the show. Fascinating to hear your views and bullish take on Chinese equities and Hang Seng outlook there. Mark Matthews, Head of Asia Research at Julius Baer. Now for a look at some of the other stories we're following today. Barclays is the latest Wall Street firm to consider returning to a 5-day week in the office for scores of its workers. Some managers have already started warning workers a mandate is likely. It's being driven by new policies from watchdog FINRA on how work-from-home setups are regulated and monitored. Blackstone plans to share ownership of companies it buys with a broader group of workers. According to an investor memo seen by Bloomberg, it is launching an equity-linked incentive program for about 18,000 employees at the climate tech firm Copeland. The move marks a more direct effort by Blackstone to give workers a shot at equity. And Deutsche Bank has realigned its Middle East strategy to be closer to Asia after seeing revenue from Chinese clients in the region double in the past 12 months. It predicts that growth to continue at a similar pace over the next couple of years. The bank has made the Middle East and Asia a joint region at some levels to capitalize on closer political and trade ties. And also coming up, the Rand is rallying ahead of South Africa's election. Annabel Bishop, the chief economist at Invectec, joins us next for more on the markets. This is Bloomberg. This is Horizons Middle East and Africa. Our top stories this morning. The Kiwi jumps with government bond yields as the RBNZ signals rate cuts may be delayed to later in 2025. Asia struggles to keep the rally going. The S&P 500, though, notching a fresh record as we await results from Nvidia. Plus, our coverage in the lead up to South Africa's election continues with Annabel Bishop, chief economist at Investec. Well, good morning again. It's just gone 8:30 a.m. across the Emirates. I'm Joanna Versace in Dubai. We are building up from some of the positive price action we had in markets yesterday. S&P another record high, up around 0.25% in the session yesterday, but yet another fresh record close for the year. Asia Pacific trading sideways. One currency pair that's in focus is Aussie Kiwi. You can see that the New Zealand currency is about 0.4% firmer versus the Aussie after a more hawkish than expected RBNZ decision earlier on. And then Brent also trading slightly underweight today, down 0.6%. But the major stock that we're watching out for later will be Nvidia. The chip maker will be reporting earnings. They've been seen as a bellwether for the AI hype in the markets that has existed over the last 12 to 18 months. Options prices are looking for an 8% move either way, to the upside or the downside. Worth remembering, though, that at the last earnings report, the stock moved 16% higher on the day after the earnings surprised by 12% to the upside. So whatever happens, we're in for perhaps a little bit of volatility later when those earnings come through. Let's check in on how markets in Asia are faring as well. Avril Hong is in our Singapore studio. Avril.
Yeah, Jumana, let's focus on what we're seeing in New Zealand cross assets as we got that more hawkish messaging coming through from the RBNZ, defying some expectations that we would see a dovish leaning. Now, it was about how that rate cut projection has been pushed back even further, and those discussions about rate hikes, not just about rate cuts. So we're seeing actually the stock gauge, which earlier clocked gains of about 0.8%, pairing much of that, and the Kiwi dollar has spiked to a 2-month high. Pressure coming through on Kiwi bonds as well. For the ball, let's take a look at what's happening cross assets in Japan, because we did get some trade numbers and it showed a deficit, and that was flipping from a surplus previously. It shows you how the weak Japanese currency is playing out into the broader economy, affecting the value of imports, complicating potentially things for the BOJ stocks. Really negative in Japan. The yields also spiking. Jumana.
Thank you, Avril, for the update. Right. Well, South Africa's top court this week barred former President Jacob Zuma from running in next week's election. Despite this ruling, Zuma will remain on the ballot, with his upstart party still the biggest wild card. So for more on exactly what's happening into these elections, my lovely co-anchor Jennifer Zavazaja joins us now from Johannesburg. So, Jen, great to see you this morning. How significant is this ruling on Zuma for this very heated and important election that is happening this weekend?
Yeah, Jumana, we're just about a week from those elections. Look, it's significant. If you think about what you mentioned, Zuma was really the wild card here, and the MK party was the big wild card. And so what we're hearing is, although, him not being necessarily a candidate may not have the biggest outcome, the question is, what will his party, the MK party, do then? What will the turnout be like? Will they be more emboldened to come out and turn out the vote? But what we're seeing from the latest polls is that the MK party is likely to become the third largest party. The ANC now, which is the ruling party, they're still expecting to get this majority. We heard from President Cyril Ramaphosa yesterday, still feeling very confident that they will get the majority, but the polls are still showing that they could dip below this 50%. And then, of course, there's the main opposition party, the Democratic Alliance, which may get just over 18%. So the question really is, will the turnout be there for the MK party and also for the ruling ANC, and what does that mean going forward?
At this point, what do you think markets are actually anticipating in terms of outcome? And from what I can see, they seem to be coalescing around the view that the ANC will actually manage to get a majority. Is that what you're hearing as well?
Well, it's fascinating, Jumana, especially if you take a look at the Rand, and maybe we can look at that really quickly, because we're seeing the Rand at a 9-month high against the dollar. And really, if we take a look at what things were looking like a year ago, President Ramaphosa and really the Rand was in a very precarious situation, because there was concern that potentially we will see an ANC have to team up with some of these lefter-leaning parties. Now we're seeing the Rand right now, there you go, dipping down to a 9-month high. And what we're hearing from a lot of strategists is potentially we will see continuity after this May 29th elections. Potentially, if there is a coalition, it will be one in which there are still market-friendly policies. And so it will be really interesting to see how the markets react continuing as we lead up to May 29th and after.
Yeah, and of course, markets are speaking for themselves. Well, sticking with South Africa, as Jennifer was just talking about, the Rand has hit a 9-month high against the dollar. The currency rose on sentiment, as Jennifer was just saying, that the ruling ANC will win enough votes to avoid being forced into less market-friendly policies. So to broaden out the conversation, we are going to be speaking to Annabel Bishop, the Invectec Chief Economist, who joins us from Johannesburg. Good morning to you, Annabel. Maybe your thoughts on what you think the most market-friendly outcome will be, and if the ANC do stop short of getting an outright majority, how damning could that be?
Yes, hi, thank you. The ANC has said it's still aiming for an outright majority, so that's their key election policy. They're not looking to go into a coalition. So I think markets have gained comfort from that. And of course, the ANC election machine does tend to kick off just before the election as well. And we have seen a lift in support. In fact, there's a daily poll that comes out from the Social Research Foundation, and that's giving us clear indication the ANC is making some gains. We do expect, however, that if it gets potentially maybe closer to 45%, it could well go into coalition with a centrist party called the IFP and perhaps a couple of other tiny parties, still allowing it to get over the 50% mark.
Annabel, what do you think that means then for the Rand? We were just taking a look at it, and really all eyes are on this May 29th election. I mean, do you anticipate the Rand will continue, though, to strengthen?
Yes, look, I think what we're seeing at the moment is the risk premium coming out of the domestic currency. We obviously saw significant risk premium in the bond market and in our Rand ahead of these elections, and worries that the ANC might choose to go into coalition with an extreme left-wing political party. As this seems to be becoming significantly less likely, the Rand is factoring out this risk premium, and I think returning to where the other emerging market currencies are, which of course are all anticipating interest rate cuts in the US this year, and that of course would see them stronger as well.
Annabel, we have a CPI print coming up, I think in about half an hour's time. It's going to be a crucial print ahead of that upcoming Reserve Bank meeting next week. What do you think, what are you looking for in these numbers? Because so far, inflation has proven to be stickier than what markets had been anticipating. And to what extent do you think food prices and perhaps that the drought has been less severe than expected could also influence this final number that comes through?
Yes, look, we are seeing CPI inflation this morning, as you said, and of course it is remaining above 5%. In South Africa, the key inflation midpoint of the target range, the point that we're targeting, is 4.5%. And we think that inflation will remain above 5% when it's printed today. In fact, again, for the rest of this first half of the year as well. We think that inflation could only come down towards the 4.5% mark in the last quarter of this year. So that really is showing the stubbornness of inflation, the stickiness, as you mentioned, and of course food price inflation, the largest component. We have, however, seen limited effect coming through from the poor weather conditions that we've seen in South Africa. We obviously have seen extreme heat, and we know that ties back to climate change around the world. We've seen weather disruptions elsewhere. But of course, for South Africa, not just food prices, but also fuel prices are key as well for our inflation print. Those have moderated recently, but they won't reflect in the current numbers. Looking forward, CPI inflation, as we said, is probably likely to remain above the 5% mark, and the Reserve Bank worries that it might only come down to 4.5% next year. Such is the stubbornness that we are seeing in disinflation.
And Annabel, I mean, that sort of points to the fact that a lot of this is imported to a certain extent. I mean, does what we're seeing with the Fed potentially have an impact in the short term in terms of, the inflation picture here in South Africa?
Yes, I think you're right. The international commodity prices are a key driver, not just for the Rand, but for inflation as well. And of course, that's even though we're a food-producing country, we're a net exporter of food in South Africa, the situation really is that we price our food commodity prices at the agricultural level, that is, against international prices, which, as you know, are dollar-based. So the exchange rate does have an impact as well. Of course, the Rand has moved significantly stronger this month, and over the course of last month as well, we did see some movement beginning. So when we see the next inflation print, we think we'll see an improvement because of that. But unfortunately, these prior high fuel and food price inflation, because of the higher Rand, obviously will provide some stubbornness there for inflation.
Final quick one for you, Annabel. What are you penciling in terms of rate cuts out of the South African Reserve Bank at this point?
So we think that it's going to be a risk of no interest rate cuts this year. The very earliest we may potentially see one is in November, but it's really starting to look like it's only going to be in 2025. We continue to believe the United States will probably cut interest rates before South Africa. Our Reserve Bank will likely be quite happy with that outcome, given that it would widen the very narrow differential between South Africa and US interest rates that occurred as the US hiked its interest rates quicker than South Africa in its interest rate hike cycle. So we think that while there's a slim possibility of a 25 basis point cut in November, it probably will now only occur in 2025.
Well, all of that has implications for the round if that does indeed play out. Annabel, thank you so much for coming on our show today. Annabel Bishop, Invectec Chief Economist, and Jennifer, thank you for joining us as well and giving us an overview into the elections. Well, with the elections in South Africa just a week away, we will be speaking to some key voices from the region on the economic and political outlook every day on this show. So stay tuned for all of those interviews over the next week. We'll be right back. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Versace in Dubai. Well, oil is lower following an industry report which points to rising U.S. crude inventories, adding to bearish signs for the market. So here's a look at how crude oil is trading, $78, around 0.8% lower on the session. Brent also sitting at around $82, around 0.7% weaker as well, and much lower than where we were just about a month ago when we almost broke through $95 to the upside. So Ed Morse, Senior Advisor at Hartree Partners, joins us now. Wonderful to see you.
Good to be here.
Look, I think all eyes are going to be on this OPEC Plus meeting, so maybe let's just start with that. I haven't seen or spoken to any analyst out there who expects the OPEC Plus cartel to change their production. And if anything, there seems to be a view that they're just going to keep the existing production cuts in space for the foreseeable future.
It's certainly the easiest of all the options to take right now. An option to either cut or to increase output is rife with kind of political problems in the group as a whole. How do you divide up a cut? How do you divide up an increase? So it's easier just to say, okay, it's summertime. There's going to be incremental crude burn in most of the Middle East. The market's going to be tighter because of higher demand and lower supply. So let's just go with it. So it's the easy decision for the moment.
And yet there are some members of the group, the likes of UAE, Iraq, who keep pushing for higher production quotas. And I just wonder how we can end up with an outcome out of this OPEC Plus meeting where all of the stakeholders are satisfied, because clearly, the Saudis are looking at the market and saying this isn't the time to put more barrels on the market. But at the same time, you have big members, the UAE, saying that they want to be producing more. And indeed, they've just recently increased their maximum capacity.
So I think the issue is how long can you get away with producing a little bit more and not have anybody scream about it? Because undoubtedly, we have not only the pressure from those two countries, from the UAE and Iraq, but there's pressure from other members of what we call the Fragile Five. Certainly Iran is among them, but it's Libya, Venezuela, and Nigeria. And they all have activities underway to attract more capital, and they can also increase production with very limited effort. I would say that Venezuela could go up 500,000 a day, Libya could go up 300 or 400 a day. And Nigeria has been producing 400 a day more than they currently are. So there's a lot of leeway in those four wayward countries that are not really part of the voluntary cuts.
Yeah. Let me just ask you about Saudi Arabia specifically. What number do you think they're targeting? What is a level for the oil price that you think they're comfortable with?
There are three different numbers that are bandied about. One is some independent analysts say the fiscal break-even, for whatever that is worth, is about $110 a barrel. There are others who say that a tighter look at the market would put it in $93, $94 range. But we recently had a very senior official from the government at the ministerial level at a meeting in another Gulf country saying we can live with low $80. And they can. They can because they have a very high credit rating. They have the highest credit rating of any country in the Middle East. They have an ability to do more IPOs with their state-owned companies, and their borrowing capacity is enormous. So they can go comfortably at an $80 price.
So I was speaking to another analyst yesterday, and he pointed to several factors. He was bearish oil. He has a view that oil is going to go to $70 in the second half of this year, and he was pointing to the amount of spare capacity that OPEC are sitting on right now, the inventory situation. We saw the report come out yesterday, the fact that demand is looking a little weak. week. And I wonder, all of these factors together, where actually the surprise to the markets is going to be that the price of oil will continue to drop in the second half. Where do you stand on that debate?
Yeah, I'm sort of on the bear side of that debate, and I start with the kind of the macro outlook. The macro outlook is deteriorating around the world. We had the U.S. growth kind of leading the industrialized world all of last year, ending the last quarter in over 3.5% growth, under 2% in Q1. We have a lot of surveys now of private economists. I'm not talking about the IMF or the World Bank, where they had a kind of 2.5% number for global growth this year. Now some of them are revising down toward 2%. If there is a move from 2.5 to 2%, that is consistent given the oil intensity of GDP with under 1 million barrels a day of demand growth. So that points to weakness, particularly when we look at the Atlantic Basin. We look at the U.S., Guyana, Canada, Mexico to some degree, but Brazil in particular, and then Norway. We have more than 1.5 million, probably closer to 2 million a day coming out of those countries. So that would be a very weak market.
And indeed, if President Trump comes back, drill, baby, drill. So we're going to get a bit more supply out of the U.S. potentially, which doesn't help. I want to ask you about China. How much of a swing factor are China playing in terms of the demand outlook here?
So China plays a swing factor. On the demand side, we don't really know. What really counts for China are imports and exports. And they adopted a policy in 2008, a year in which oil was hit at $147 Brent. People thought it was going to hit 200. It ended the year at $41 or $42 Brent. And they adopted a policy of buy low and sell high. And they've been pretty consistent on that. Now, there are a lot of political issues involved as President Xi tries to control the once independent companies. But the basic structure is to build inventory when you can. They have capacity to build 2 billion barrels. I think they're at about 1 billion, 200 or 300 million. They have the largest inventory of any country in the world based on import needs and demand needs. So they're still going to be doing that.
Yeah. What do you think it would take for OPEC Plus to start putting more barrels on the market again? What are they waiting for?
Well, I think there are two different time horizons on it. One is wait and pray that the made-up number that they have on oil demand is going to materialize, in which case the market can tighten up pretty quickly. There is a little bit of an exaggeration on the amount of spare capacity in the world. There are other things going on. Russia is not standing still, and I don't know, nobody knows what's going to happen to Russia internationally, but they're now developing the Vostok field. That's a 2 million barrel a day field, and they plan to have a good 500,000 barrel a day of incremental supply in the market this year. So I think one of the movers traditionally of Saudi Arabia in particular is that if supply grows too quickly, to try to stem it by putting more oil in the market, reducing prices, and making it a punishment to produce more by bringing price levels down below the costs.
I believe they call that a Pyrrhic victory. So they're going to be winning and punishing others, but at the same time, as you say, that break-even level is very high right now for Saudi Arabia. And I would love to continue the conversation, but we're going to have to wrap it up here. Always a pleasure to have you on our show.
Thank you for having me.
Big fan of your research over the years. That was Ed Morse, Senior Advisor at Hartree Partners. Also coming up, a Bloomberg scoop on a kill switch for chips. We get all the details on what that means coming up next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jemana Versace in Dubai. Well, Bloomberg has learned that ASML and TSMC have ways to disable the world's most sophisticated chip-making machines should China invade Taiwan. Huge story. So for more, let's bring in Chan Koch, our Amsterdam bureau chief, who joins us now. So tell us a little bit more about how this technology actually works and what would enable the chip makers to switch off its usage.
So our sources have told us that ASML and TSMC have ways to disable the world's most advanced chip machines if China invades Taiwan. The remote kill switch applies to ASML's extreme ultraviolet machines known as the EUVs, and TSMC owns half of all of these machines in the world. Our sources have told us that ASML has reassured Dutch officials about its ability to remotely disable the machines when the Dutch government held a private meeting with the company on the invasion threat. The Dutch administration had even run simulations on a possible invasion in order to better assess the risk.
I mean, I guess that sort of brings up, the political backdrop to this and the fact that there are so many tensions between the U.S. and China. It looks like they're seeking technological solutions in case things really flare up in the future.
So true. The same sources basically told us that officials from the U.S. government have also privately expressed concerns to both their Dutch and Taiwanese counterparts about what would happen if China invades the island, responsible for producing the vast majority of the world's advanced semiconductors. ASML's technology is so sensitive and so important that it has long been subject to U.S. government interventions. The Netherlands prohibits the company from selling EUV machines to China because of U.S. fears they could land China an edge in the global chip war. So this secret capability to remotely kill the machines is a way to reassure Washington.
Yeah. Very clear and fascinating story. Thank you for bringing it to us. Well, that is it for our show. This was Horizons Middle East and Africa. I'm Jumana Versace in Dubai. Stay with us for Daybreak Europe. This is Bloomberg.